So you've just finished a 50 grand project, feels good, right? Except the client's paying in 60 days, your subbies want paying in 7 days, materials are due in 14, and you've got 3 more jobs in exactly the same position. So what happens? You're busy, revenue looks great on paper, but when payroll day comes, you're scrambling for cash again. You transfer money from another account, call in favors, stretch a supplier, maybe dip into the VAT account, and hope that the client pays on time this month. Sound familiar? If you're nodding, trust me, you're not alone. This is the construction cash flow nightmare, and most business owners I speak to are right in the middle of it. I'm Ahmed Kayoum, a chartered accountant and finance director for construction firms and founder of Blue Water Accountants. The difference between construction businesses that grow confidently and those constantly in cash panic comes down to one thing: a 13-week rolling cash flow forecast. Today, I'm going to show you why cash flow is uniquely challenging in construction, what a 13-week forecast actually is, how to build one for your business, and how to use it to stop cash flow stress for good. If you're frustrated with constantly firefighting cash shortages, this video is for you. So let's dive in. So let's start with the big question. Why is cash flow such a massive problem in construction? Because construction cash flow is different, completely different. Let me explain. In most businesses, you sell something, get paid, then deliver it. Simple service, simple payment cycle. But in construction, you deliver first and often wait 30, 60 or even 90 days to get paid, and that payment period is optimistic. Then you add retentions, 5 to 10% held back for 6 to 12 months after the job is finished. Now add your own costs. Subbies expect payments within 7 to 14 days. Materials are cash on delivery or at best 30 days. Plant hire comes in every week. Payroll, weekly or monthly, doesn't wait for clients to settle their invoices. So your cash leaves your account far earlier than it comes in. Let me walk you through this timing mismatch. It's March. You finish a fit out worth 50 grand. It costs you 40 grand to deliver. You paid your subbies, suppliers, labor that same month. In April, you invoice. Looks great, but it's just a PDF invoice, no cash yet. In May, maybe June, the payment hits. Except the money isn't profit, it's filling the hole you dug 2 months ago. Meanwhile, you're starting new jobs. The same pattern repeats. Outflows now, inflows later, always behind. Maybe your P&L says you made 80 grand profit last month, yet your bank balance only shows £3,200. How? Because profits don't pay bills, cash does. And by the time you realize you're in trouble, it's usually too late to do anything proactive. Year-end accounts don't help. They're historical, too slow, too late. That's where the 13-week cash flow forecast comes in. So what exactly is a 13-week forecast? Well, it's a rolling week-by-week view of your cash position over the next 3 months. 13 weeks. That's 3 months, 1 quarter, short enough to be accurate, long enough to spot problems. It shows what's coming in, what's going out, and what your bank balance will look like every single week. And here's the best bit. You don't need to be a finance expert to build it. So let me break it down. It's not a budget. Budgets are usually set yearly. They look nice on paper. They rarely match reality. It's not a P&L. That tells you what profit you made, not whether you've got any cash available. A 13-week forecast is forward-looking. It focuses on cash, not profit. Here's what it captures. Cash coming in, client payments due, ideally based on realistic payment timing, not just what the invoice says. Retentions that are due for release, any other income like rebates or equipment sales, and cash going out. So like subcontractor payments, supplier bills, plant hire, payroll, VAT, CIS, corporation tax, insurance, rent, software, loan repayments, anything that you've got going out of your business. Every week you have opening balance, plus money coming in, less money going out, and that equals your closing balance. That closing balance becomes next week's opening balance, and so on. Each week you add week 14 to keep the forecast moving. So why 13 weeks? Because it captures most payment cycles and gives you enough time to plan ahead. Now you can see if week 8 is going to break you before it happens. No more surprises, no more panic. If you're thinking this sounds great, but I have no idea how to build one, then don't worry. I've got a free 13-week cash flow forecast template that you can take and use straight away. The exact one that I use with clients. You'll get it instantly when you sign up to the Smart Contractor, my free weekly email newsletter for construction and trades business owners, and the link to sign up for that is in the description below. And while you're there, take the construction finance health check too. It takes 3 minutes and goes through 5 areas of your finance function, including cash flow, and it's also linked below. Now let me walk you through how to build and use a forecast that actually protects your business. So here's a simple version. It's 4 steps. Step 1, list all cash coming in. That's all invoices issued that will pay over the next 13 weeks. But be realistic with payment timing. Don't assume clients will pay on day 30. Add expected retention releases and any other income that you expect will come in. Step 2, list all the cash going out. That's subcontractor payment dates, supplier bills, material invoices, plant hire, payroll, VAT, CIS, corporation tax, your fixed monthly costs like rent, insurance, software, finance payments. List everything that's going out. Step 3, map it week by week. Start with your current bank balance. Then for each week, all the cash coming in, all the cash going out equals your closing balance. Step 4, you update it weekly. Every Monday morning, update all the actual payments received, adjust any missed or delayed items, and roll the forecast forward and see the next 13 weeks ahead. So some of the tools that you can use to develop this forecast could be in an Excel spreadsheet or Google Sheets, and my free template makes this really easy. The link's in the description below. You can also use Xero's cash flow forecasting tool, as well as other dedicated tools like Float or Pulse. And we typically use Float for our clients because it integrates directly with Xero. And it's not about the tool, it's about having a forecast and using it. So here are 4 ways it changes how you run your business. Number 1, you can spot problems early. If week 9 shows a negative balance, you now have 8 weeks to solve it, not 8 minutes. You can chase clients early, delay non-critical costs, speed up invoicing, request stage payments, arrange short-term funding. Now you're ahead of the problem, not in it. Number 2, it helps you make smarter decisions about taking on work. A new job is offered. Sounds good, but the client pays in 60 days. Can you afford it? Check your forecast before you say yes. If week 6 is already tight, you can negotiate better terms, delay the job, or even turn it down. That's how you avoid taking on projects that ruin your cash flow. Number 3, you negotiate better terms with clients and suppliers. If clients want 60-day terms, you can say, well, based on our cash flow, we can't support 60, but we could do 45, or we could split it into 2-stage payments, or perhaps you could pay a deposit upfront. If suppliers want immediate payment, you can say, well, if we pay on delivery this month, can we agree 30 days for the next 3 deliveries? Forecasts give you leverage. Negotiation becomes strategic and not desperate. Number 4, know when it's a dip, not a disaster. Sometimes cash dips are normal. Timing between jobs, VAT payment quarter, a slow period. The forecast lets you see the big picture. If the balance recovers in week 12, you don't need to panic in week 4. But if it stays negative week after week, then something's structurally wrong. You need to fix pricing, cash terms, or costs. The forecast helps you distinguish between short-term dip and long-term problems. Now, if you're still here, that tells me you're serious about solving your cash flow stress. So here's your next step. First, I'd recommend you sign up to the Smart Contractor newsletter and download your free 13-week cash flow forecast template. The link's in the description below. Then I'd recommend that you take the free construction finance health check. It will highlight where your cash flow process is strong and where it's not. And if you're turning over more than £500,000 a year and you complete the health check, I'll walk through your results with you on a free 30-minute call. We'll review your results, identify the risks, and create a plan. Stop guessing, stop reacting, get visibility. Make decisions with a clear view of the next 13 weeks and not hope. If this video helped, then hit subscribe. I've got more construction finance content on its way. Thank you for watching, and I'll see you in the next one.